we go. All right, so here we are. We're getting ready to start the our wonderful class on FHA, and we're going to be talking about all sorts of fun things today related to FHA loans. And so kind of what this is going to be a real good crash course. We are going to do a little bit of math on this, but for the most part, we're going to be going through FHA and what FHA really means to you as far as loan types and products. It is very different. Last time I think we talked about conventional loans. Is that right? So this time we're talking about FHA. There are two main categories of loans out there, conventional and government. So out under the government standard is where the FHA loan now comes into play. FHA is probably for those who have marginal credit or not as good a credit or not as much money for down payments. This is probably one of the most popular loans that we use when it comes to that. There are several different varieties of this. We'll talk about the FHA and a couple different varieties related to it. But for the most part, FHA is the structure for most of the government loans. There are some nuances with some of the other government loans under VA, USDA, some of those other ones. But for the most part, what you're going to be dealing with is if you can understand the conventional structure and you can understand the FHA structure, everything else will kind of fall into place. Okay, so anyway, we're going to go through that real quick, and let's see if I can do this. All right, there we go. So here's the objectives for today. We're going to give a real quick introduction to FHA and how it started and what it started for, some general basic information, the different types of loans underneath it, what mortgage insurance and case numbers mean for this type of loan, what it means for the automated underwriting system. We talked about that last time. You remember the automated underwriting system, the green beret status of real estate. Okay, so that's a big one. We're going to talk about it again. What qualifying ratios mean, how they handle significant credit events, how properties and appraisals are done. And then obviously, if you have any questions, we'll kind of go from there on that as we go along. So first of all, what you need to know about FHA is federal. They're one of the bigger players in the mortgage and in mortgage times. Now, if you look at when it was started, you can see there in the top paragraph, it was started in 1934. It was started after the Great Depression. And the whole purpose for FHA being started when it was started is because during the Great Depression, thousands of people lost their homes to the bank. And so the banks were, at that point in time, they had some regulations to where the banks would only lend money if you were putting between 20 and 50% down. And so you had to have some significant money in order to be able to make this work. Now, what that meant to the buyer who had just gone through the Great Depression is they just did not have the money to make this work. And so they started going back and forth between the governments and the bank, and the government said to the bank, hey, you guys have got to loosen up. You guys got to help these people who just lost homes. They can make their payments, but they just don't have the cash to put 20 to 50% down. They just lost everything. You got to help them. Homeownership is pretty important. We want to make sure that these people can get into homes again. So they went back and forth. The banks were like, no, we lost a ton of money. The value isn't there. We're not going to do it. So somebody came up with this brilliant idea of let's form the Federal Housing Administration and let's help people who have the means to be able to make the payments establish home ownership. Now they came up with this fancy thing that we're going to be talking about there, which is called mortgage insurance. They're the ones that piloted this program. It was not there before. Now it has bled over into conventional loans because now we have mortgage insurance for pretty much every loan out there. But back at that point in time, this was groundbreaking. There was nobody out there doing this. And they formed the Federal Housing Administration. And as you can see in the first point up there, that they did this so that they could insure mortgages so that the banks would feel comfortable lending money when they're not putting 20% down. And so that was actually phenomenal and groundbreaking at the time. And so they have a long history since that time of being one of the biggest choices for first-time homebuyers when it comes out in the market. And they service a lot of great segments. You don't have to be a first-time homebuyer to use it, but not everybody is going to want to use the FHA loan for everything. FHA loans are phenomenal, but they're short-term solutions for housing. So what I try to counsel people in is if you're buying the house with an FHA loan, understand that's the strategy that helps you form this house in this household, but it's not the strategy for long-term, because long-term you want something different that is going to be able to save you a ton of money. And we're going to go through calculations on this so you can kind of see what I mean. So we as lenders, we are not allowed to advertise as FHA. We can sell FHA loans. We can help people get FHA loans, but nobody can use the FHA logo to brand themselves or anything like that. It's specifically just something that is reserved for them specifically to do. Now, with these types of loans, these are considered to be full documentation loans. So what that means when we're dealing with full documentation means we have to prove that they have the ability to repay this loan. In other words, that beyond reasonable doubt, they can support the monthly payment and that they have the assets to be able to support it should something go wrong. Now, because there is some guaranteeing from the government, then in essence, it's not necessarily something that's extremely hard to do with FHA compared to conventional, but it's a great tool to help them. There is a minimum down payment requirement that is 3.5%. Now, 3.5%, just using round numbers, 200,000, 3.5%, that's a $7,000 down payment. Okay. Now, we're not talking down payment assistance loans yet. We're having another program another class where we're going to talk about some of the down payment assistance loans out there where they can help cover that 3.5%. But this is just strictly FHA. Once again, the structure for most of these loans. So 3.5% is required. They do have to bring it from their own money. Now they can get a gift for it, which means that they can get family members to help them out. They can't get friends. They can't get people who are not a blood relation. It only can be people of blood relation to help with these gifts.
No sugar daddies, no sugar mamas.
Yeah, no sugar daddies. No sugar daddies in this case. You're right. So loans are available for primary residences, and that's what you're going to find for government loans. All government loans are specifically for owner-occupant primary residence. There's no second homes, nothing like that. Now, you can get an exception for certain second homes, but I'm going to tell you that it's very difficult to get an exception. Okay. You would have to be able to prove some significant. In other words, what that means is you can only have one FHA loan at a time. Okay, so the exception, what that means is if I were to all of a sudden get transferred to Northern Virginia, let's say, and it's too far for me to commute on a daily basis, which I would consider that to be too far to commute, then what they would do is they would extend me a second FHA loan if I needed one to buy up there, as long as I can support both payments simultaneously. Okay.
What about a husband-wife comment? The wife has the primary residence and then the husband wants to buy an investment property.
So investment properties can't be bought with FHA, but they can do that, yes. So if the question is if the husband and wife, let me just rephrase it, make sure I hear it. So the husband and wife own a property together.
No, she's on the house.
She's on the house and on the title.
By herself.
Okay.
And then he wants to buy something.
Yeah, if he wants to buy something, he can do that with an FHA if he wants. You wouldn't be able to buy it as an investment, but they could buy it as a primary. Okay, so he would be the only one moving over to that one. Okay, now in some cases too, we have had a circumstance where Junior, for example, wants to buy this house and he can only go FHA, and mom wants to co-sign and she has an FHA, and they can do that too. Okay, but the hard part is if you want two homes with two FHAs for one person. Okay. All right. So FHA loans are assumable with the current terms, but you do have to be qualified as the owner occupant. In other words, they're not going to just say, give you a rubber stamp and take it over. Okay. Now, credit requirements for this type of loan are very simple. They do require a minimum of a 580 credit score in order to be able to get into this. Now, if you're going down to a 580 credit score, you do need to know that they are going to be requiring what are called compensating factors. So if you look at the rest of that paragraph, it says that FHA allows a score below 500, but you have to put more than 10% down at that point. And usually when you're dealing with somebody in that category, you're dealing with somebody who doesn't necessarily have the means to be able to do something like that. So generally speaking, what I'm trying to do, and especially in these days with all this COVID stuff that's been happening, they've really put a lot of pressure on those lower credit scores. And so what I really try to encourage people to do is to spend some time working on their credit, bringing their credit up. That way we can improve the situation for them long-term, because otherwise what's going to happen is they may get the house, but it might be at 5.5% interest when the market's really at 3%.
Yeah.
And so it's not necessarily that they can't, it's just like, how much do you really want to spend to do this? Okay. So anyway, they do have a maximum loan amounts. These loan amounts have actually changed. In the Richmond area, it's actually $548,000 is the maximum loan amount that they'll let you have. Now you can see there though, that if you go up into what are considered high priced properties or high priced areas like Northern Virginia, New York, some other areas like that, they have a higher area, because in Northern Virginia and Fairfax, I don't even know if you can get indoor plumbing for $548,000. Okay. And so, that's something that when you get into those areas, you're going to be spending a whole lot more money. They have to find a way to make that work. One other thing that is extremely important with this is you can buy multi-unit. Multi-unit meaning a duplex, triplex, or a quad with an FHA. And this is if I could go back in time and talk my wife into buying a triplex back in the day when I first started getting ready to buy a house, I would have totally done it. Because you can use the income from 2 of the units to help pay for the 3rd unit. And so now you've started the first piece of your investment portfolio, because your requirement in that house, okay, in that triplex is 1 year. And so if you were to move into something like this, if you've got somebody who's ambitious, who wants to make something like this happen, they can go out and buy a triplex. They have to have 3.5% down. So on a $400,000 triplex, that would be $14,000 plus closing costs. But let's say they're getting $1,000 per unit in rent, and it's only costing them $2,200 for the total mortgage. In essence, they're not even paying a mortgage. Okay, and so it's a tremendous way for them to be able to get into this, and it's a great strategy, especially for the first-time entrepreneur who wants to buy that. The reason why I say it's good for the first time is because if they live in a $500,000 house and now they want to buy a $400,000 triplex, it doesn't make sense to the underwriter, and it's not going to work. Okay.
Yeah, I mean, wouldn't they have to be able to show that they're going to be getting income from that?
Yeah. Yeah, we can use that income to qualify.
Okay.
Oh,
But I mean, how would
Awesome,
you be
even
able to,
though-
how would they be able to show that if they don't already own it and they don't already have tenants?
So did everybody hear that online? I don't know if you heard that online or not, but how do you show that if there's no tenants currently in the building and that they can't see exactly what that projection of rent is? The answer is that the appraiser, when he goes out, and you pay a little bit more for this type of appraisal, but the appraiser actually, when he goes out and appraises the home, he goes and does a rent schedule. And the rent schedule tells us what the average rent is in the area for properties with similar attributes.
Okay.
And so we can, in essence, take whatever the rental schedule is off of that and help offset what we have there.
Gotcha.
Okay, and now it really does help if they have a lease that starts on or around the time they take possession,
Right.
but you really don't have to have that.
Gotcha.
Okay, so
That was my question.
anyway, so we've dealt with that. We're going to go on to the next one here real quick. The different types of FHA loans. First of all, you can get them in a variety of years, starting at 15 and going in 5-year increments. Yes.
would that be the same for like if you did other kinds of loans, you could still count that in as your
Yeah.
income? Okay.
So on a conventional loan, you can do the same thing. On a VA loan, you're in an area where there's a fair amount of VA down here. On a VA loan, you can do the same thing. They can buy a duplex, triplex, quad, and they can use the income to offset the payment. Now, they can't use more income than the actual payment. So in other words, if they're trying to get $4,000 out of the rental so that they can qualify, we can't do that. So they're only going to be able to use enough rental to offset the actual payment. Okay. All right. It doesn't boost their income until year 2 when they've already owned it for a year, and we can see the path and how they've handled it. Okay. FHA loans are offered in 5-year increments, starting at 15 all the way up to 30. 30 is the most common one we deal with on the market. Periodically, we get into 15 and 20 and 25. Temporary buy downs are allowed, but I'm going to tell you that most of the time that is not, that we have to qualify them at the higher rate. So most people don't even do that. And with where rates are right now, it doesn't make sense. We have adjustable rate mortgages with this type of program as well. And there's nothing wrong with an adjustable rate mortgage, but you need to know why you're getting an adjustable rate. when you do this, because it's not something that's automatically a good deal for you. Now, if rates go up to Jimmy Carter days, 17, 18%, then yes, now ARMs may start making more sense. But right now, they just don't make any sense. You can do special energy efficient improvements. You do have to make sure that they're cost effective. So here's what that means is if you wanted to add insulation or you want to replace the windows, you can do that on the house. But the hard part is the way that they make you calculate this. They make the contractor calculate how much money they're going to be saving per month. That's really hard to prove. Okay, really hard to be able to forecast. And so while it's available, it's next to impossible to do that without a renovation loan. A renovation loan you can do that with, and that's called the 203K. And that's what the next one is, which is the FHA allows financing of repairs in a streamlined or limited repair program called the 203K. They do also have a full 203K, which will go up to whatever the value of the home is. And so on a 203K with a full value, what that means is if you buy the home at 150 and the real value of the home finished is 300, they'll let you finance all the way up to that 300 minus your down payment, okay, in a renovation loan, which is a great way. So we're going to be getting into a day, I think, with all the stuff that we've had with forbearance, we're starting to see more and people getting into trouble on selling homes. And so what we're going to start seeing is we're going to start seeing more and more homes hitting the market that are in distress, that need a little bit of help because they haven't been able to keep up. So this type of loan is not necessarily a bad thing for that type of client. It is a little bit more complex. We have an entire training just on that, so I'm not going to go into a ton of detail on it, but it is something that you just need to be aware that it does exist. It's called the 203K. That's our shop talk and how we call it.
The rates on those are probably much higher, right?
They tend to be the rates. The question was, are the rates higher? And the answer is yes. The rates are between 0.5% and 0.75% higher.
Oh, that's not bad.
Does
Yeah,
that
it's
work
not
as
bad.
draws? Like we talked about last time, like your contractor fixes the
Yes.
HVAC and then you get to pay the, you don't get $150,000.
That's exactly right. Yeah, there is a construction manager that handles it for you. And so they have to go out and they have to verify that the work has been done. And then based off of the milestones and when the contractor is getting things done, that's when he gets his check. Okay. Let's see here. Reverse mortgages do exist. I don't know a ton about them, but they do exist and they do work. And then they have a full refinance program. You can do FHA to FHA if you'd like to. Now, mortgage insurance, let's talk about this real quick. Since FHA was the starting point for mortgage insurance, let's understand what this really means to the consumer and why they put it in place. So back in 1930s, after the Great Depression, the banks are like, we're not lending money. We're just not going to lend it to consumers unless they're squeaky clean. Well, I mean, tons of people just lost their homes, and homeownership is a massive thing for community revitalization as well as other things like that. So what mortgage insurance is, they finally agreed between the banks and FHA that FHA would insure these loans or guarantee these loans, and that any losses made by this consumer because they didn't make their payments on time or the home ended up being foreclosed upon would be borne by the FHA. That's where the mortgage insurance came in. So there is no free lunch with all of this. There's no free nothing on all this. What ended up happening is they ended up coming in, okay, and saying, well, the consumer now is going to buy an insurance policy against themselves so that when that time comes that they are going to be, in this house, they're going to continuously be making monthly payments, including this mortgage insurance. And that is going to be what funds the disaster fund for when somebody actually has to turn in the house. It does not protect the consumer. It protects the bank. And so if somebody were to default, the bank is the one protected, not the consumer. So in essence, you're buying an insurance policy against yourself in case you ever have to turn in the keys. So it can be a very expensive insurance policy. So grab out a calculator real quick. You're going to help me do some numbers. The first thing that they do, grab a calculator, and let's take a $200,000 loan, okay? And we're going to multiply it by 0.0175.
3,500.
Okay, so 3,500. That is what is called the funding fee. So what that means is you're buying this policy up front and you're paying $3,500 for it. It gets added to the loan. So now if you have a loan that started off, you're buying the house at $200,000, you put $7,000 down, which means theoretically speaking, you should be at a loan amount of $193,000, right? Well, now you're adding that $3,500 to it. So now you're at $196,500, right? Okay. Now you're buying that policy, but you still have a monthly component. So take that $196,500 and multiply that by 0.0085. How much?
1670.
1670. So 1670 would be your annual payment for that mortgage insurance divided by 12.
139.
So you're paying $139 per month for that insurance policy, as well as the $3,500 that gets added to your loan. So now that's starting to turn out very expensive. Now take that 139 and multiply it by 360 payments, which is 30 years.
$50,000.
Do you have a better place for $50,000?
I was thinking that could be your, ain't it true if you pay one payment extra a year, you drop it
By 5 years, yes.
So-
But you don't ever eliminate this mortgage insurance.
And they just changed that recently, didn't they? Because didn't they used to, FHA, it used to drop off when it
Right.
got to 20%?
Right, so this change where now it no longer drops off is really related to the crash of 2009. So in the crash of 2009, prior to the crash of 2009, when you got to 20% ownership, it fell off. But since the crash of 2009, it has been there for the life of the loan. That's why you have that 50,000. That's why when I started talking about this, I said, this is a great program to help you start out in life, but it's not where you want to be long-term, because you're wasting $50,000 on an insurance policy that brings you absolutely zero value. And so you have to, at some point, in my opinion, get your credit to recover enough so that you can bring that up and then go refinance into a conventional and eliminate that number altogether. Okay. All right. The FHA case number is down there. So every time you're dealing with an FHA loan, there is a case number that gets assigned to each of these houses. There's a reason why I'm saying this, and this is very important. We're going to talk about appraisals in a minute, but here's the real reason why you have an FHA case number. It attaches that valuation to this house. It attaches that client to this house. It attaches that lender to this house, because they want to track and make sure that they have a performing loan. They want to track and make sure that this insurance policy is attached to a specific home with a mortgage insurance. Okay. But it also follows with the appraisal. So the appraisal, when they do the appraisal on the home, it also follows that home, and it follows it for 180 days. So 6 months. Okay. So if you have an appraisal on this home and the appraisal comes in under value, let's say you're doing 200,000 on this purchase price, but the appraisal comes in at 185, that appraisal sticks with the house for 6 months. Anybody attempting to buy this house within those 6 months is going to have to resort back to that appraisal.
Even in this market.
Even in this market. Okay. Now, there are ways to be able to cancel that and to be able to start over. But if that case number was in the last 45 days, your chances of getting a cancel are not very good. Okay. Automated underwriting system. We talked about this last time. And what are your recollections about the automated underwriting system?
It's a lot better to do that than it is just to get the pre-approval.
Right. Okay. So with the pre-approval, you actually don't have a pre-approval unless your lender has run it through the automated underwriting system. You physically don't have a pre-approval, period. You just don't have it. And so this automated underwriting system, all loans, even FHA, have to be run through the automated underwriting system. The automated underwriting system for Fannie Mae and for Freddie Mac are desktop underwriter for Fannie Mae and loan prospect advisor for Freddie Mac. These, what they do is we put all the data points into the electronic record that we have. And then what happens is we submit it to Fannie Mae and Freddie Mac. It takes 45 seconds for them to check all these data points and spit out an answer as far as what's going to happen. Now, I can't show you any of this stuff online right now. Maybe after the class, I can show you a little bit about how that reads. But these are some very important pieces for you because those underwriting conditions is what we underwrite to. Now, this is also extremely important because those underwriting conditions are the base guideline by which a loan gets done. So there's two main factors. There's two main reasons why a loan will fail and why a loan will fall apart. Number one, those data points weren't inputted correctly into the system. And when they finally get them correct and they run it back through the automated underwriting system, there's a good chance that it doesn't make it through there. You get a refer or an eligible instead of an approval. If you get that refer, you can still do a manual underwrite, but that manual underwrite is very difficult for the consumer and it's very stressful. If you get an ineligible, that's when the loan's dying. Okay.
Is that because the loan officer didn't put the information in correctly?
Yeah.
So it's just operator error at that point.
Maybe, yeah.
Okay.
So the main reason why you will have a denial on a loan is that right there, is you can't get it through the approval on the Fannie Mae, Freddie Mac automated underwriting system. Every loan out there has to go through it. Okay. So that's number one. You can see right there under this line right over here, I don't see right there, it says McLean Mortgage underwrites to the findings from these automated systems. And so in essence, what we're saying is that we don't have any overlays on top of that. What an overlay is an additional requirement above and beyond the automated approvals. These additional requirements are things that are not required by Freddie Mac and Fannie Mae, they're required by the bank. So the two reasons why a loan can be denied, one is you don't get the automated underwriting approval. And two, you may have an overlay related to the bank that doesn't necessarily apply to the reality of what you're dealing with. Okay. And so here's, for example, an overlay that you would run into. Virginia Housing and Development Authority is one of the most common ones that has, in my world, that's the only one that I deal with, it has an overlay. They're the ones that provide us with down payment assistance and the grants, okay? They have a maximum debt ratio and a maximum income cap that they force us to abide by. If we go over top of that debt ratio or that income cap, they're going to deny the loan. It doesn't mean I can't do it with Freddie Mac or Fannie Mae. It just means Virginia Housing won't take it. Okay. Now that is a very, very good common example because their debt ratio example is 45%. Well, you can actually go much higher than that with a regular FHA loan, but that is considered, but there are other things that happen too when you're dealing with overlays. Certain banks have overlay requirements, for example, that the buyer would have to observe, for example, like reserves, means additional savings. That, yeah, you have to put money in for the down payment, you have to put money in for closing, and Freddie Mac and Fannie Mae say you're going to meet the guidelines just fine. But the bank says, no, that's not good enough. We want an additional 3 or 4 months of savings before we're going to let you buy this house. That is a bank requirement called an overlay. It is not a requirement by Freddie Mac, Fannie Mae. Okay. So this, going back once again to Green Beret status within real estate, this is what you need to be talking about when you start meeting with clients that have pre-approval letters from people that you don't know, or as the listing agent, you have received an offer with a letter from somebody that you don't know. You need to call that loan officer and find out, here's the 3 questions that you need to ask. These are I'm regurgitating these from last week or last time. 3 questions. Number 1, have you run AUS and what were the results? You have not asked for any personal information so far. Have you run AUS and what were the results?
What do we want the results to be? I mean, what's the
You
right
want an approval.
approval? I
Yeah.
know the terminology.
Accept, approve, or approve eligible. Okay, that's number 1. Number 2, are there any items in the findings that the borrower will not be able to satisfy? Because I can't show it to you online, but here's what happens. When Freddie Mac and Fannie Mae get back to us in that 30-second window, they send back a list of conditions that we have to satisfy. And I need to read through those conditions and compare them to the file, because that's what's getting underwritten. And when I'm asking, I'm not asking anything personal. I'm just saying, have you read, in essence, have you read the findings? And do you feel good enough about those findings to where that borrower is going to be able to get through them just fine?
What would be like an example of that?
Disputed accounts. If they have, like I've dealt with disputed accounts quite a bit. If you have more than $2,000 in disputed accounts, your file's dead. You're not doing it. But sometimes those disputes show up as a one-line item on the credit report. And what it says is borrower disputes, borrower and seller resolve, borrower disagrees with the results and still disputes. If you don't read that entire thing all the way to the end, you wouldn't know that that thing was in dispute. And I have missed them before. I have missed them. And so I've had to go through the process, of removing those disputes so that I can help them get back to where they need to be. Okay, so this is a pretty big deal. So the AUS is going to be a massive thing in order to be able to get you into that point. That's Kara. She'll get in here in a second.
She got the wince on her face like she doesn't remember the code.
Yeah, that's fine. We'll make her suffer through it. So that's a big piece that you have to figure out with when you're asking for these things, is what's going on there. So make sure that you ask the listing, whoever the selling agent is, make sure that you ask the selling agent the same thing. Say to them, hey, what the heck, what's going on here? We need to know what's going on, what's happening, so that we can, make sure that we're not doing this in error. So question number one, do you have AUS approval? What are the results? Question number two, are they able to satisfy the conditions from the findings? Question number three, are there any overlays that your bank has that this customer may have a hard time satisfying? Now you've asked them the three most important questions. If you get an answer that you don't feel comfortable with, it's time to move on either to a new lender to get a pre-approval, or it's time to go look at a different candidate or a different offer on that house.
What was the second one again?
The second one is first one is do you have AUS approval? What were the results? Number two, are there any conditions on the AUS findings that your borrower will have a hard time satisfying? Number three, do you have any overlays that may bring problems to your buyer? And so now what you've really tried to find out is, has this person done enough due diligence on this file to make sure that this is going to work? Okay. And that's pretty important. And you can use this for the listings that you're representing when you get the offers, and you can use this for the buyers that you're representing that may have come to you with a different lender that you don't recognize. Okay.
But then if you're if you're the listing agent, you're doing this when you're receiving offers, not after you've already ratified contracts and all that.
Yes. So when you're starting to vet the clients, you're taking those lender letters. There's usually a phone number on the lender letter, and you're calling this lender and you're saying, hey, Mr. and Mrs. Lender, I just want to ask you three questions to see, what you've done with this file. Number one, have you run AUS? Okay. And what are the results? Number two, are there any conditions that they're gonna have a hard time satisfying? Number three, do you have any overlays?
Is that common practice? I know you said it's green beret status.
No, it's not common practice.
Okay. In
But-
other words, I feel like in real estate, you hear a lot of stuff, but then when you go to do it, people are like, what are you talking about? So-
That's exactly right. But this is why you need to do it,
Okay.
because this is why you need to do it. And the reason is because you don't have a loan. If something happens with these three questions, you don't have a loan. So you may be going through 30, 45 days of this thing only to end up that your loan is denied. Okay. And so the whole point of this is to make sure, and I'll show you findings after we go offline so you can kind of see what I'm talking about. Okay. All right. Moving on to the next one, qualifying ratios. So DU and LP actually determine the qualifying ratios for each of these loan types as you run it through there. They're going to tell you where the max is. They're going to tell you where everything is in reference to it. They're going to tell you where it starts. They're going to tell you where it stops. Okay. Oh, looks like we have a question online. Just a second here. Let's see here. We got a chat. Somebody here wanted to say something.
So like, so you should be calling that.
Let's see. I can't see that. Yeah, you need to call, you need to get a hold of that listing agent, find out. Mhm.
On your listing, I'm saying you need to be calling the buyer, the lender for the buyer before you would send all that stuff. If you were a Green Beret, right, is that right? I mean, I'm hearing that right?
Yeah, you are hearing that correct. You need to be calling them.
Call the person that just made an offer on my house, call their lender
Call their lender.
and ask them those 3 questions.
Yeah. I get the calls periodically. I don't get them as often as I should, but I get calls like every now and then. Now, what I try to do when I'm sending out a letter, what I try to do is I actually try to call that agent. So if I know who the agent is, let's say Scott's putting in an offer on your listing over there, and he doesn't really know you very well, but he knows who you are, Scott will forward me your phone number, and I'll actually call Scott, call you and say, hey, I just want to let you know that I've talked to Mr. and Mrs. Smith. Mr. and Mrs. Smith, I've looked at their credit, I've looked at their income, I've looked at their assets. I've run it through the AUS. We have an initial approval through the underwriting system. Things are looking really good. Okay. And so that's what I tend to do. Now, what I'm saying is if you don't have that happen, is you need to pick up the phone and call me and find out if that's what's going on. Because now there are certain candidates that will be that for example, like with the FHA programs, and I can call all day long and say that stuff. But if they're competing against cash offers, it really, you may love me, but you don't love me that much. Okay.
So do we, I mean, is that something that we should be doing prior to accepting an offer? Or is that something
Yeah.
we need to do once the contract is ratified?
No, you need to do it before you accept the offer.
Okay.
So the questions for you online is should you do that before you accept the offer? And the answer is yes. You need to be doing this before you accept the offer, so that you can make sure that you're not accepting something that you just physically can't do. And so I would highly encourage you to go and make sure that you're asking specifically these questions before you ratify any contracts. As a Green Beret in the industry, what you want to do is protect your buyer from having damaged goods. And what happens is if it falls apart on day 26, when you're closing on day 30, okay, now you've got damaged goods. And so now you want to prevent that from happening. And the only way to truly prevent it is by doing what I just told you to do. Okay.
Yeah, because there's a lot of back on markets that come through, where
Right.
everything fell through.
Right.
You check those hot sheets, everything, it's constant
Mhm.
back on market.
Mm-hmm.
So,
Mm-hmm. And those people back on market don't usually get the same price they got the first time. Right. So that's a problem. All right. Qualifying ratios, once again, they do have a hard stop and a soft stop. The soft stop is right around 43% as far as the debt ratio, but the hard stop on these tends to be right around 52, 53%. Now, once we get up past the soft stop, we do have to have compensating factors. And by compensating factors, what that means is we need to be able to show that there is a significantly good reason as to why they need to be able to go up higher. So that means better credit. It means more savings. It means they have stability in their job, other items like that, in order for us to be able to help them at that level. Additional, and in the qualifying ratios, what we are looking at is, you can see right there, for all the housing ratios, the borrower must qualify with the actual payment for the property, including property taxes, homeowners insurance, mortgage insurance, and any HOAs or homeowners association dues. Now, when you get into a condo, right there, you can see what it says on condos. I want to make a very specific case on condos, because for an FHA loan to work with a condo, the condo has to be listed on the condo approved list. If they're not on the condo approved list, they are not getting this property. Okay, at least not with an FHA loan. It doesn't mean that they can't go and get a conventional loan for it, For FHA, they are not getting it.
Where do you find that?
So there is a very specific website. Let me see if I can get out of here and I'll show you where the website is.
You said that's from a condo approved list, that's the terminology?
Yep, it's a condo approved. Okay, so I'm gonna get out of here for a second. I think there was a chat in here. Can you repeat those 3 questions that need to be asked by the lender? Okay, did you get those questions, Alicia? I just want to make sure you got them. Okay, you can unmute yourself, by the way, if you would like to ask a question live, but we'll go back into the chat as well. So if you haven't gotten those questions.
Sorry, I forgot I could do that. I just didn't get the third one. It was just a lot. I couldn't hear it all.
Yeah, the third one is about the overlays. So do you have any overlays that you are unable to satisfy? So you're asking the bank if they have any overlays like that, okay?
Clean the house.
All right, cool. So here is, I'm going to take you real quick on a little detour because you've asked about it, is you have to go to the FHA. You can see I have it highlighted right here, the FHA condominium list. And this is a condominium list for the entire country. And so, what's that? Oh, crap, I don't have it there.
It's okay, it's too much, just.
All right, let me go ahead and share screens again. And I'll come over here. Here it is. All right, so here it is, the FHA condominium list right here. This is the list that you actually have to go through, and you have to go and, oh, there it goes again. All right, stop share. Let's go ahead and close out of that.
Still there.
Maybe it won't let me close out of it. All right,
If we
so
Google it, we'll find it, FHA condominium.
yes, you should be able to, let me see, I should have it now. There it is. Okay, so here's your HUD.gov, and this is the FHA condominium list here. Okay,
HUD.gov, and then
yeah, if you just Google FHA condominium. Here it is right here. Okay. And you really do have to look it up.
okay.
You really, really, really do have to look it up if you want to make that one work. Okay,
Is that that's not townhouses, that's just condos?
it's just condominiums, yeah.
Does FHA do townhouses?
FHA does do townhouses, but you don't have the same level of scrutiny. Okay,
All right.
Is this supposed to be showing for us on Zoom or no?
is this what I'm sorry?
Is this supposed to be showing for us on Zoom, what you were doing?
I
I didn't see that.
probably, I'll have to put it out there so that you can see it. I don't know if I can get it out there now. Let's see. Try to do it one more time.
Chris, what's the reason for the condo list?
Oh, cancel. The reason for the condo list, and so the condos are actually very different. You can't minimize when you're recording. Okay, so you cannot, with the condos are very different in that when you own a property that is a condo, you actually don't own the property. You actually are a percentage owner of this property, but you are not an owner of the property. Okay, and so here's what I mean by that. I know this is totally convoluted, but here's what I mean by that. Okay, let's say there's 52 condos. Are you able to see it now, Alicia?
No, I just see everyone on Zoom.
You can see that. Okay, so let me just do this one more time. Here's that. Can you see it now?
Yes. Thank
Okay,
you.
great. So when you are an owner of a condominium, and let's say there's 50 owners in this condominium association, you actually do not own anything except for what's inside the walls of your unit. And so the problem is now you've got that going all the way to that property. You've got 50 owners. You're 1/50th of an owner of the entire premise. So the reason why there's a big problem is, let's say 10 of those owners are behind on their homeowners association dues. Okay, that's how they fix the plumbing. That's how they fix the roof. That's how they fix the fenestration, the window, anything related to the house, heating, cooling systems. There's one condo association in 2009 that went defunct, and they started charging $4,000 a month in homeowner association dues.
Wow.
They were that far behind. And the people who were making the payments, okay, the people who could make the payments, were subject to the problems of the ones who weren't making the payments. You see what I'm saying? And so there's a huge problem when it comes to condominiums because of that. So FHA has said that unless you have a very specific and you meet these guidelines, they're just not approving it. Now, conventional has some of the same stuff. Conventional does require some of the same stuff, but they're not nearly as stringent. They look at it on what they call a case-by-case basis. So they're going to look at the homeowners association packet and see the budget to see how many people are behind. They're going to see how many are landlords versus how many are owner occupant and stuff like that. And that's what's going to determine whether you can actually buy inside one of these condos or not. Okay. All right. So back to the presentation. We got a couple slides left. I'm going to go ahead and try to do this again. All right. So there's that. Come back and share screens. Maybe. Where's my Zoom? All right, back to where we were, mostly. We were almost at the end. Qualifying ratios. All right, so yes, this is the qualifying ratios we were talking about, HOAs and condo associations. The next one is additional qualifying information. So this is very specific right here. So interested party contribution. So who would be considered an interested party? The seller, right? They're interested in making this transaction work.
The buyer,
The buyer would be interested.
the agents.
The agent would be interested party. The lender is sometimes considered an interested party as well, right? Because I'm going to get paid a commission off of it. So the max concessions that you can get from an interested party towards the buyer's closing costs, in this case, with FHA, it's different in conventional, but with FHA, it's a max of 6%. Now, it can only go towards real and actual costs, which what that means to you is it's a use it or lose it. So if you got 6% of 200,000, that's what? $12,000, right? But if your closing costs are only 7, that balance, $5,000, goes back to the seller if you don't catch it ahead of time. So if you do get $12,000 in seller concessions and they can only use 7, they're losing 5. So what do you do with the other 5? You get a price reduction. Okay. Something to keep in mind. It's a use it or lose it. You cannot use the seller concessions towards down payments. You can only use it towards real and actual costs, and those real and actual costs are the cost to close and settle on this property. Now you can use it for points, which means you can buy down the rate. You can use it for closing costs, prepaids, which is your homeowner's insurance, your HOAs, other things like that, or your true legal fees to make this happen. Another one of which is like a homeowner's warranty, policy. So if you wanted to get a warranty policy for the house and you have excess money, we do that. Sometimes I've had to buy 3 years of it. Okay. But that's a way for you to get some of that money used.
This might be a stupid question, but does this affect like realtors commissions?
If you sacrifice your commission to help them close the house, yeah.
Oh,
But it's not going to affect it if you don't sacrifice any.
okay.
Okay. All right. Cash reserves. Many times you're not required to have any cash reserves for this type of loan, but that does not apply to multi-unit. Remember we talked about multi-unit again. Now here's where the next thing comes in under gifts is you can receive gifts for the entire transaction on single family. So if mom or dad or grandpa want to give money so the junior can buy his first house and they're going to give him all $26,000 at this cost to make it work, they can do that. Where the gifts do not apply is on multi-unit. If you're going into a duplex, triplex, or quad, now you have to have that money yourself. Otherwise, it looks like an investment scheme and you're doing investment mortgage fraud. Okay, so you're not getting a gift like, and I've had this happen before, where a guy wanted to put his college kid in a house down at VCU, but he wanted to be the one that donated all the money for the 3.5% down plus the closing costs on a $900,000 quad. Okay, now if Junior had that money, it wouldn't have been a big deal. but it was dad giving the money, and it was truly an investment scheme. Dad was going to make some money off of this and pay it back and all this other stuff. And so that's part of what they were looking at right there.
How long do you have to have the money in your account for it not to be seen as
2
a
full
gift?
bank cycles.
So if I can, I'm not suggesting mortgage fraud, I know you wouldn't either, Chris, but if
Yeah,
I give it to Junior on January 1st and he doesn't buy a house until May 5th,
right.
we're
Yeah.
okay.
It can't be a joint account, but yeah.
Okay.
Because if Junior's not good with your money and all of a sudden you go to close and it's not there.
Junior spinning off?
Yeah, Junior's got a really nice car,
Okay.
you know,
Okay.
you know, it works, okay? Use of rental income, you can use that on multi-units, but you can't use that on primaries. And if you're buying a home, let's say your departing residence is you're buying a new home with an FHA loan, and your departing residence, you want to convert to a rental, we can't use the income. With FHA, they're very restrictive with this. You can't use income from the departing residence to offset the new home. Only with FHA. With the other loan types, you certainly can. Borrower eligibility, it is specifically for owner occupants. You can have non-occupant co-borrowers, but that's pretty much it. You can get non-US citizens, they can use this if they have a valid work permit, they have a valid residency, they have a valid visa status in this country. You can use this to buy a house. Now, you can't buy it if you don't have legal status. You can't use it without any sort of legal status. You can get a second mortgage in this. That's actually how VHDA does their down payment assistance, is they provide you with a second mortgage in order to be able to help you with that down payment, okay? Borrowed funds, borrowed funds have to come from an acceptable source. And so here's what that means, is you can't go and get a credit card advance in order to get the money for closing. You can't go get a signature loan to get the money for closing. It has to come from a secured transaction. And by secured transaction, what that means is you can do it as long as it's from something that securitized it, like a car, a boat, a house, something of that nature. You can certainly get a loan off of that to use it for a down payment, but you can't get a signature loan. Now, why would you think that they wouldn't let you do it with a signature loan?
Because this is more money you're out, you're spending more.
Well, that's part of it.
Payments. You have to make payments on that, right?
Well, that's part of it. So we do have to add that back in to your debt ratios. Yeah, so you still have to make payments, but that's not the real reason. The real reason is because if you take that money from an unsecured source and now you apply it to a secured source, that source now has rights to this house. And what they don't want, the bank doesn't want to sacrifice any of their rights to do this, because you know, if they're going to invest $200,000 in somebody, they want to make sure that they're the ones getting paid back. Okay. And where this runs into problems too, is like if we're dealing with one guy right now that hasn't paid his taxes from 2019. Well, guess what? If he wants to buy this house and we just found out about it, he's going to pay his taxes from 2019. Because if he buys this house, taxes don't come in and take second position, they take first position. And so now the bank is like, we're not letting anybody
What
do
about
this.
2020? I mean, shouldn't he have paid those already?
How did he even register his car is what I want to know, because I didn't even know there were vehicle
I don't know,
taxes.
but I'm going to tell you that there's so much
I
crazy
can't get
stuff.
my
I see
registration
crazy
number.
stuff with taxes all the time.
I'm just saying, I would feel like if he's got to do his 19 taxes, he's got to do his 20 taxes too.
Well, he did, and he owed money for 2020 as well.
Oh, okay.
But he owed, between the two is like 25,000.
Oh, wow.
You know, I mean, it has to be fixed. It just has to be fixed. Okay, so we have to consider, if you do open up additional debts, we do have to consider those debts towards that qualifying piece. There's that. Okay, so significant credit events, this does talk about those. Now, I get this one quite a bit where people are in a Chapter 13 bankruptcy and they want to go out and buy a house. While theoretically, the guidelines do say that you can do this, I need to let you know that theory and practice are not always the same. And so theory and practice on this, theoretically speaking, can you do it? Yes. You have to have the blessing from the trustee of the bankruptcy that you can open up this new credit and that it's not going to affect you from finishing your bankruptcy and that it's not going to be included in the bankruptcy, so on and so forth. Getting that approval is not necessarily hard. The hard part is that they have to have a ratified contract to present with it. Well, who in this day is going to ratify a contract when I can't even give them a pre-approval on it? Okay, and so that's part of what you're looking at. But these are foreclosures, deeds in lieu, different things like that. There's a 3-year waiting period. Short sales are considered to be the same thing as a foreclosure deed in lieu. But once you're discharged, they are a little bit more friendly to you being able to buy or do what you need to do to buy these houses. Properties and appraisals, we have talked about this a little bit. They can give you, they'll do valuation with this, but what you're going to be finding is that please don't include any personal property in this. So no kitchen tables, no lawnmowers, no whatever you call those things, pools that are above ground pools. Don't include a boat in it, nothing like that. So if you want to buy some of their property as they're selling it to be able to move, you certainly can do that, but it needs to be done through a separate source. Okay. Property flipping guidelines. This is extremely important. We run into this all the time. And with a property flipping, you absolutely cannot buy the home until the home has been owned by the flipper 90 full days. You can't even put a contract in on the home until day 91. So we do run into this periodically. And so here's what that kind of needs to mean to you is if you're running into a situation where you want to buy a house that a flipper has, you have to make sure that the flipper knows what's going on. Okay. You can write the contract for it before day 91, but it's going to have to be canceled and replaced on day 91 because you can't even have a contract. We can't even start the loan.
Yeah,
Okay.
I've mentioned that a couple times with some of my investors.
All right. Well, that is pretty much it for today. So I am going to stop the recording. And by all means,
I will say this.
if you have